Hello, welcome back. As the stock market is absolutely getting decimated these days, it's a prime opportunity to examine some companies that have been solidly down and they are still doing great in terms of financials. So, I'm going to suggest five companies from different sectors in industries which I think are very nice to add to a portfolio right now and just let them do their thing in the next few years or so. In fact, they could even go down a little bit more in the current market slump, especially as interest rates rise. Maybe you want to have those in your watch list and see when you want to add to your portfolio, if you potentially want to add them, of course. But I will suggest a few that I think are interesting purchases here, and I am looking to add to my portfolio myself. Now, there are more than these, of course. I may be making more compilations in the future, but I just don't want to be adding random things. I want to be examining companies for their financials and actually indeed find companies that I solidly believe have a position to a fair portfolio right now, especially after the slump. So we're starting off with Foot Locker, and Foot Locker is an apparel industry company, which means that even though you can see consumer cyclical here, apparel is actually required by people. It's an item that we cannot do without. It's an important thing. It's clothing, apparel, food, things of that sort are important. And even if we are having a downtrend in the economy and a downturn in the economy, we still are going to be seeing people buying food and buying apparel. These are important products that we all need to survive pretty much. And so, of course, there is a little bit of fashion hidden within these kinds of companies. But the point about Foot Locker is also the financials. You can take a look at this company and see that their PE ratio is sitting at 3.4 over here, price to free cash flow at 6.22, and this is what I love to see. And the company has been buying shares back like crazy, another thing that I love to see here. And so this is a company that has a low debt over here, great return on equity. Look at this dividend yield, 4%. This is another fantastic thing. And even better, the payout ratio is amazing. It's very, very low. The free cash flow payout ratio is 24, less than 24%. And this means that we are looking at a company that is a very, very solid buy because it can actually provide us with a very nice dividend yield that seems to be pretty safe right now. And especially during times where inflation is high, getting a little bit of extra dividend, getting a little bit of a safety net here, it would be nice for a portfolio. These kinds of companies tend to do rather well when we're entering recession phases in the economy, or especially when inflation is high and interest rates are high. So I would definitely like to suggest Foot Locker. And also, I always take a look at the actual stock evaluation tool here, because if you take it through the tool, you will see that for a revenue growth of 2, 3, and 4%, which is much less than what the company has been doing, for example, the last year, although it's close to their averages. Net income margins 6, 7, and 8. Free cash flow margins of what the company again is doing, generally speaking, lower than this, apart from this year, which was the other one out. And at annual return of 13%, we're getting the max price to pay of 81 bucks, while the company's current price is sitting at 27. So I feel like Foot Locker is actually very, very undervalued right now, and I would definitely look into adding this one to my portfolio. Looks like a very, very solid company, as I'm saying here, increasing revenues, increasing margins, increasing net income, increasing free cash flow as well. Yeah, 2022 hasn't been the best, but overall the company seems to be doing well and amassing some nice free cash flow, bettering their balance sheet. It's a company that I would definitely recommend. Okay, let's move on to the next one. Next one is going to be PayPal. Actually, this is the one that I want to start with because PayPal has been down massively, 75%, and at some point it used to be overvalued. But right now, you can take a look at their key metrics here, and they are getting better and better. And price to earnings ratio is slightly elevated, but still, for a company of this sort, it may be just fine paying a little bit more. And also, the price to free cash flow is where we'd like it to be, and less than that. Outstanding shares going down. A little bit of extra total liabilities here compared to the free cash flow, but that's not necessarily a problem, of course. Return on equity, which is pretty nice, great margins as well. Company looking very solid, and if we take a look at the stock evaluation tool, you will see that almost everything is green here, apart from the low estimates, which are sitting at 10 revenue growth. And look at this historical table here. Everything has been about 18% is basically what the company is doing every year, and the revenue growth that I have added is at most 14. So this is probably, even these estimates make sense. So the net income margin, again, I have been pretty conservative with my selections here and the values that I have used. And right now, based on what I'm seeing on PayPal, it is a company that I'm definitely looking to add to my portfolio. Very, very cool one, especially having dropped that much. It's entering the territory that I cannot ignore right now. So what's the next one? Next one is going to be Alphabet, Google, a company that has also dropped quite significantly, about 25%. And there are some very, very important things about Google. It may not seem super cheap, and you can see here that the price to earnings ratio is 22, price to free cash flow ratio 23. That's not necessarily high. It's not really that high for a company that's growing that much, and it's also a tech company that is doing pretty much great in all frontiers. Plus, there is another very, very important thing. They have announced about $70 billion in terms of buybacks. And so the outstanding shares will go down, which means that when that happens, our current valuation is going to be even lower. And so if we take a look at our stock evaluation tool, you will see that it's only our low estimate that is a little bit lower than what we'd like it to be. But all the other ones are actually very green here. Plus, remember, there is going to be some share buyback, and so eventually the outstanding shares are going to be lower, which means that these projection values are going to be higher. There's going to be less stock available, so these prices, the projected prices, are going to be higher. So we're looking at a company that very soon may even have this value at a green over here. And again, for a company that is doing so great, and a massive company that had 41% increase in revenue growth last year, and look at what they have been doing in the previous years, for me this is a very, very solid buy right now. Even if for our low estimates it's a little bit more expensive than what we would like it to be. Again, there is a lot of things to love here. Share buybacks, great growth. It's a company that I'm definitely buying right here, and I have bought actually. So next up, Intel, a company that I don't own and I really, really want to add to my portfolio. I've talked about this a lot. Another company that has a very low P/E ratio, a relatively low price to free cash flow ratio, right on where we would like it to be actually. Anything below 20 this becomes a green. Outstanding shares that are going down, 13% down. And another company that has great return on equity, which is one of the values that I absolutely love to see. Great net income margins as well. Company also paying a little bit of a dividend, and a very, very safe one at that. I mean, not the safest one, but 55% is pretty safe in terms of the free cash flow payout ratio. And let's take a look at the actual evaluator tool, because you will see here, oops, I have actually missed, I think I refreshed the page. Let me actually do it again. Alright, yeah, I think I accidentally refreshed the page when I was adding my projections here. And you will see that the revenue growth of Intel hasn't been the best, of course, because again, it's a behemoth, it's a very large company. You can't expect it to be growing tremendously every year, although it has been positive pretty much every year. I went very low, 1, 3, and 5%. And the net income margin, 25, 26, 27, which is right in between what they have been doing. Free cash flow margin, 70, 80, and 90. This was a little bit of the odd one out, but generally speaking, that's what they have been doing. And if I hit calculate here, you will see that we're all green over here, 46, 60, 77. And this is why Intel is definitely a company that I'm looking to add to my portfolio as well. And I would definitely suggest this one. For the fifth and last one, I wanted to go with something in terms of pharmaceuticals, because when we are entering a recession, if we enter a recession, pharmaceuticals is also another industry that people cannot avoid. They need to get their medicine, they need to be paying for this sort of thing. So healthcare is a sector that generally doesn't get tremendously beaten down when there is a recession, when when the stock market goes down. And so I really, really wanted to add a company of that sort, and especially a company that's paying a relatively healthy dividend here, 3.4%. And remember, it's much more important to take a look at the free cash flow dividend payout ratio than the net income payout ratio. This is pretty much how dividends are paid, free cash flow, not net income. And so a company that you can see that has a relatively high debt to equity ratio, but the careful observer, you will notice that the return on equity is very high as well. And so typically when this happens, companies utilize their debt in order to increase their return on equity, and this seems to be the case for this company. Great net income margin as well. And you will notice that, yeah, the company has been diluting investors a little bit. That's probably the only bad thing to see here. Other than that, things are much, much better. But this sort of dilution is a little bit concerning. I'd love them to stop doing so. They seem to have stopped. 2019 was the last dilution attempt, really. So yeah, I doubt that we're gonna be seeing extra dilution going on soon, anytime soon, because the company has been relatively down a little bit. So I don't expect them to sell more right now. I wouldn't expect that. So that's probably the only thing that I don't like. But if I take a look at the stock evaluation tool, you will see that with the projections that are again fairly conservative and net income margins that are right in between, free cash flow margins that are very conservative actually based on what the company has been achieving, we can see that our projection results are again pretty nice, and it's only the low ones that are a little bit off. But other than that, medium ones that are green, high ones that are green as well. And remember, this is again a pharmaceutical company has this extra nice thing that it can do pretty well when there is a slowdown, and also it's paying a hefty dividend that is looks sustainable. It looks very sustainable compared to the free cash flow dividend payout ratio. And so I think AbbVie definitely has a potential role to a portfolio that wants to be a little bit defensive as well. So I did select companies from different sectors for different purposes, being a little bit defensive, being a little bit more aggressive, buying value because that's my most important thing, because I don't really care about the short-term fluctuations. I want to be buying value regardless of what's happening in the markets. Yet, you kind of cannot really avoid at least taking a look at what's going around with the environment and also potentially add something to your portfolio that could be nice to have in regards to, let's just say, dividends, for example. And this is why some of the companies that I've added, AbbVie, Intel, for example, are paying some hefty, nice and safe dividends here. So thank you for watching the video. I hope you enjoyed this one and I hope it gives you some ideas. Let me know what you think about these companies and which other ones you'd like to recommend, maybe for another compilation video, because I will probably be doing maybe one or two more about interesting companies. And this kind of video takes a long time to make because I'm examining all sorts of companies to decide which ones to go for the compilation, the best ones that I can find. And again, thank you for watching. Please leave a like. Again, that really helps because there's a lot of effort going on this one. And remember to subscribe if you are not a subscriber. And I'll see you around in the very next video. Thanks for watching again. See you soon. Bye bye.